For this mock exercise, we're going to take a look at a company called Renowski Company, and we're going to take a look at the concept of back flush costing. Let's take a look at the question. So this company makes telephones. For June, there were no beginning and ending work in progress. So there's no beginning material, no ending work in progress or beginning work in progress. And they use just-in-time production system and backflash costing with 3 trigger points for making entries. So they only record when they buy material, when they complete the item to finished goods, and when they sell the finished goods to a customer. Now, if you think about the process of making telephones, there are probably multiple departments that particular unit, the phone, the finished goods go through, from the beginning of the raw material stage to the actual phone itself. And with the multiple layer of departments that the telephone process goes through, if you don't use backflush costing, what will happen is companies will end up recording the transactions, each step as it moves into the actual production line. So as it goes from one department to another, there's going to be journal entries to transfer cost and calculate costs, going from one department to another. And it becomes quite horrendous in terms of the bookkeeping aspect of it. So what happens is companies may actually implement backflush costing where they only record at these 3 trigger points. Now, in June, to do backflush costing, you need standard cost. So that's the other thing. A standard cost for June, direct material, is $3.20. So this is standard direct material. And standard conversion cost is $18. And you can see why backflash costing is not allowed under IFRS or ASPE, because it does utilize standard costing. Okay? But you'll see in other videos that we can probably circumvent depending on how much cost of goods sold and any inventory we have left on hand at the end of the year. It may not be material. So companies who use backflush costing would have to manage the level of inventory and work in progress so that they're able to perhaps use this and still be in accordance with GAAP, because the difference is not material. So there are 3 levels of inventory account. There's raw, inventory raw, there's work in progress, and there's finished goods. These are the actuals. So they've got raw materials purchased, conversion cost, number of finished goods, and number of units of finished goods sold, and how many were manufactured. So the first question says, prepare a summary of journal entries for June without disposing of over and under allocation and conversion costs, assuming no direct material variance. The second part is post the journal entries to a T account, and we need to create these T accounts. So let's do that. So remember the 3 trigger points, right? So the first trigger point is the purchase of raw materials. And that's the first trigger point which requires us to do a journal entry. So we're going to debit raw materials inventory, and credit accounts payable. And that one was for $6,360,000. Our second trigger point is, and the other thing we need to do is we need to actually record a conversion cost. So record conversion cost. And the actuals incurred is debit conversion cost, control account, credit various accounts. So the actuals is 3696. So if I'm going to do a T account down here, which I'm going to show you, I got my raw materials. I'm going to debit that one 6360. And I'm also going to have a conversion T account here. And I'm going to debit 3696. So normally the debits are actuals. So this is the actual side. Okay? So the 6360 is debited, always on the right hand side, the raw material control account. So this is the raw material inventory control account. The reason why it's called a control, because there could be multiple different raw materials T account depending on how deep they track their raw materials inventory. And of course we would debit the actuals for conversion as well. Now the other trigger point, so this is the trigger, right? Let me circle that. The second trigger point is the completion of finished goods, right? And this is the another trigger. And trigger means that's when they record the journal entries, right? So because there's two in this trigger, the purchase of the raw materials. Now, how do we determine the completion? We need to debit finished goods. And we need to credit raw materials and credit conversion cost. Now, how much are we going to do that? Now, we're given budgets. So we're told that the raw materials, there's 200,000 units, and the standard raw material is $31.20. So that we're going to credit 6240. And this conversion is 200,000 times $18, which is 3,600, 3,600,000. So the sum of this is 9840. So these are standard. So we're going to credit 6240 and 3,600. These are allocated using standard. And the fourth entry is another trigger, which is the sale of goods. And that sale of goods is going to be debit cost of goods sold, credit finished goods. How many did we actually sell? We sold 192 units. So 192 times 3120 plus 18. That's 9,446,400. So what's happened here is you can see that there's another finished goods T account. We're going to have the 6240 here and the 3600. And we're going to take out 9,446,400 to cost of goods sold. Okay, so what's left? So you could see that this The remaining balance is $120,000. And this one has got $96,000 conversion cost. And the finished goods has a balance of $393,600, and that's your cost of goods sold. Now, you could see that this is not the complete answer, because you could see that this cost of goods sold is not GAAP because it's not actual. This finished goods inventory is also not GAAP because GAAP requires us to record actuals. So part of what you learned so far in the course was all these variance analysis and looking at comparison between actuals and standard. And you're going to have to figure out how much of these variance you need to adjust to bring it back to actuals. So part of making this into GAAP, allowed by GAAP, is to be able to book some of these over and under allocation of conversion cost and raw materials and adjust those finished goods for those variance analysis for those raw materials and conversion costs. Okay? Thank you.